Good morning, everybody. Welcome to the Flow Show. I'm on my Todd today because Kay's still off and Stelios has some errands to take care of. So just me on my lonesome to keep you entertained. So might be a little bit of a shorter show today. Can't keep talking that long, much as I'd like to. Hope you're doing well. Let's get stuck into things. China, the rocket that is dollar CNH continues to plough higher. We've got up near the 7.13 level. Keeps on going. They fixed the rate at 7.0821 last night, pretty much unchanged. But as you can see there, we continue to rally in dollar yuan. I'm all out of my longs. I could slice no more, so a final chop was done for me at in the 712s, so not a bad run from 692. Quite happy with that. Didn't really get a dip to get back into some longs, add back into the position, a dip that I would like anyway. So I'm now back to sitting on my hands. I still think we may get stronger comments if we get up towards the high 710s, up towards 720s. Maybe if we get up there, I'll start to think about potentially leaning short, particularly if we start getting stronger comments from those guys there. Overnight, and as you can see, they're coming in softer, particularly for manufacturing, contracting to 48.8. Was expected to move 51.4, but it's coming lower than the prior contractionary number, 49.2. Services doing a bit better. Was expected to pull back, but it's still held up. 54.5, so a slight miss on what was expected, but still well into expansion. So that was one of the reasons why we've seen the yuan weaken a bit further today. China's National Bureau of Statistics came out saying that the Economic Recovery Foundation is not yet solid. Those comments after that data there. So that could be tipping them towards perhaps another RRR cut. That seems to be their favoured tool at the moment, as opposed to some of the shorter term rates. So we'll keep an eye on that one if they do decide to cut rates again. Probably likely see dollar yuan even higher. Coming over to Japan, and a lot of data out everywhere today, really. Industrial production looking a bit worse on the month, down 0.4%. Expectations for the month ahead also coming in lower than last month. Retail sales, particularly large retailers, falling 1.2% month on month, was expected to come in flat. Year on year for April coming in at 5% versus 5.8 expected, so softer numbers there. So data coming out of Japan, not entirely looking too hot, but it's been a bit up and down, more up than down in the main. So that remains the theme there. As you can see there, a bit more data. Construction orders, healthy 16.2%. Consumer confidence, household confidence, also coming in better than last month, though missing expectations, but a little bit softer in housing starts. So you can see again, Japanese data, a little bit mixed on some, but moderately all going the right way for now. Inflation is a big feature today. We're getting the German regional numbers ahead of the main German number later today. It started off with North Rhine there, inflation coming in at 5.7% versus 6.7% prior. Was expected to rise a pip, but I don't pay too much attention to those expectations in that one. So down a whole 100 pips on the year-on-year number there for North Rhine. Import prices as well coming in negative both on the year and on the month. Further falls on the year, or on both of those, down 7% versus minus 5.9 expected. So this soft inflationary pressure continues in the Eurozone for many of the countries there. France CPI coming in 5.1% versus 5.9 prior, much worse than expected. The HICP number, the Eurozone number, coming in also lower, 6% versus 6.9 prior. PPI as well, a big fall there on the month. Consumer spending also down. So you're getting the theme here now. German unemployment data. Unemployment change 9K, so better than expected. Unemployment rate remains at 5.6%. Italy's GDP numbers coming in there, 1.9%, bit better than expected. Year on year, quarter on quarter, also better than expected. There you can also see more of the regional German numbers there. So big falls there. Baden-Württemberg down coming in at 6.6%. So over 100 pips better off there. The same for Bavaria, same for Brandenburg, same for Hesse. You're getting the message now. So the main German number is out at 1 p.m. UK time, 12 o'clock GMT today. And we'll have a look at that, what's expected there as well. Italy, CPI as well, coming in lower on the CPI number, coming in lower on the HICP number, though not as much as expected. But we're all trucking the same way. There you can see Saxony as well, a big drop there for the CPI. True. So here, quick look at the regional number, what we're expecting for Germany. Where was it? 1 o'clock. So inflation expected to rise to 7.3% from 7.2% in the CPI, and expected to rise to 7.8% from 7.6%. Based on all those regional numbers we've got earlier, I think those expectations are probably very wide of the mark, and inflation is probably coming in much lower. That's going to take some heat off of ECB rate expectations, although we're still pretty much pricing 94% chance of a 25 pip hike, an 8% chance, 6% chance of a 50 pip hike. So these numbers may get some in the market drawing down expectations for the ECB, but I don't think they will by much. Just looking at the RBA, and have I missed it? Where was it? Might be under yesterday's stuff. Nope, there. So Aussie CPI also coming in a bit softer, though beating expectations. And RBA's low came out to say, oh, I've got the right number there. Where are we? CPI. Yep, that's the right one. CPI there. So RBA's low came out and said they are focused on growth in unit labour costs, and nominal wage growth has not been a source of inflation, very much in data dependent mode on interest rates. Coming back to the ECB and just saying that, talking about rate expectations and all those CPI numbers coming in lower, that's not putting off any of the ECB members, or a lot of the ECB members. ECB Simcus still expects a 25 pip hike in June and July. Spain's ECB bod Centeno says Spanish CPI reading shows European inflation is easing, doesn't see risks of monetary policy overshooting. ECB's Muller says it's probably too optimistic to see ECB rate cuts early 2024. Core inflation shows no signs of slowing yet, and it's very likely that the ECB will hike by 25 pips more than once. ECB's Villeroy, quite likely we have passed the inflation peak in France. He's had to wait a while to be able to say that one. ECB's De Guindos says victory over inflation is not there. The trajectory, though, is correct. So despite all these lower inflation numbers, which are still at pretty elevated levels, there's still a ton of ECB members all talking hawkishly and expecting more than one, some more than two hikes to come. Not that you'd know it from the euro right now. Now, here we go with forecasts. So Goldman Sachs has raised its Bank of England terminal rate forecast to 5.25% for September versus its previous forecast of 5% for August. You all know what we think of forecasts, and particularly Goldman Sachs, and my good old mate Michael Brown called this up yesterday. This is what they said in March, that UK inflation to sink below the BOE's 2% target this year. That was in March. Would I say yesterday? Inflation to top the Bank of England target till at least 2026. So in the space of 2 months, they've gone from it's going below target to being above target for another 3 years. So that's what we think of forecasts there. Not worth the paper they're written on. So anyone who trades bank forecasts, good luck to you, unless you go any other way, of course. Just looking over to the US data that we got yesterday, some housing prices out from the Case-Shiller and the FHFA. Nothing really to report there, although prices were a bit lower. It definitely looks like there's some cooling coming into the market. Prices were actually up on the month in the 20 city component, 0.5%, but year on year down 1.1%, not falling as much as expected though. The FHFA house price index coming in softer than last month, though beating expectations, and also showing a gain on the month. So just a little bit of cooling. It's been a bit of a trend for this one. The national Case-Shiller HPI data came in at 0.66% versus 2.13% prior. So that's the national number for the US. And I have noticed that has been coming in, getting lower and lower. So perhaps not as fast as a drop in house prices as we might expect, with rates having run up so fast so quickly and continuing, but it could be that we see a decent cooling in the housing market. What would be healthy is just that, a decent cooling rather than a collapse. If we do get any big problems in the housing market, that's likely to feed into the Fed's minds, and they'll think more about pausing rates, and that's likely to get the market thinking more about cuts if there's problems appearing in the housing market. So that's one to keep an eye on for when we're trading the cut expectations, which we will be doing so over the months ahead. We also got the consumer confidence, the main conference board consumer confidence number there, beating expectations by a decent amount, coming in at 102.3 versus 99 expected, though it was a bit of a dip over last month. Now within those components, current conditions fell a tiny bit to 148.6 versus 151.1. Expectations rose, though, in May to 71.5 versus 68.1 previously. And that all-important inflation measure came in, the one-year inflation expectations came in at 6.1%. That was down a pip from last month's 6.2%. So no real cooling of inflation expectations there from the consumer. Fed funds futures now price a 63% chance of a Fed hike in June. The rate probabilities I've looked at this morning are matching that pretty much. We're pricing 64% for 25, and no change is the other side at 36%. So we're not pricing a 50 pip hike at all. It's 25 or unchanged in that one. Fed's Barking said that policy is in restrictive territory. Sees uncertainty around where rates need to go. It's hard to count on rate hikes to do all the work on inflation. Some parts of the US economy appear to be cooling, while others remain vibrant. There is more willingness among businesses to try and increase prices, and expects that to continue until demand falls. So he's seeing firms still looking at raising prices, which obviously will keep sticky inflation in the US if that comes to pass. Now we've got the debt stuff going through. We've moved into the next phase where a deal's done and every Tom, Dick and Harriet from both parties, every house, are coming out to either throw their weight behind the deal or throw the hand grenades out that they're going to try and blow it up. So without going over picking out every senator that's come out to say yay or nay, I'll try and pick through the debris of all those comments. Democrat Republican Boyle said enough Democrats will support the debt limit deal. US House Leader Jeffries says he expects Republicans to keep a promise of at least 150 votes for the debt limit bill. So that's some numbers being put on potentially what was promised by McCarthy in the talks, that there will be at least 150 votes in that House. Republican Representative McHenry says more than half of House Republicans will support the debt ceiling bill. However, there are some hardline Republicans who are pledging to torpedo the deal. So as we've been talking about, particularly on Face and Dale mentioned and Blake mentioned, there still may be some wobbles going into the votes this week, but it's looking like the numbers should be there. We'll always hear more from the people who want to be against the deal in the press than we will those who are backing it. So there's still, I think, a small risk that there's problems with votes. Obviously, if one of the houses don't pass the bill and chuck in a load of amendments, that's going to create big wobbles in the market. So be prepared for that. And I'll try and look a bit later to get the full details and timings and numbers and everything like that. Maybe we'll discuss that on the Flow Show. What has happened since the deal was announced is that the good old credit default swaps have been tightening, i.e. some of the angst is coming out of those markets. US 1-year CDSs have fallen 80 basis points, so pretty much over halved to 53 basis points from Monday's close of 133. 5-year CDS have fallen 41 pips from 56, fell to 41 basis points from 56 basis points as of yesterday's close. So at least that's one element of the market who's been cheered about the deal so far. Now, we've had this drone business going on, apparently, with the UK, Ukraine flying drones over Russia into residential areas. The Beverly Hills of Russia, as it's been called over there. People seeing drones flying over there. Russia said that Russia has a right to take the harshest measures in response to the drone attack on Moscow. This has caused a bit of angst amongst the Western folks because the US has been strongly against Ukraine taking action in Russia, mainland Russia, well in within the territory. But the UK Defence Minister came out saying that, well, it's absolutely fine if they want to do that. So a bit of a split there, perhaps, coming between the different Western powers. As always, we wait to see what Russia has done. One thing it may do is give people in Russia a kick up the arse as to what's really going on. It's one thing when the war's being fought, several hundred miles away, and it's not affecting you. But when drones start coming over your house, and it's come over some pretty big people in Russia, some of the billionaires, and the Gazprom CEO, I think, was one of them. That area saw drones as well. That's when the bigwigs will start sitting up and paying attention and maybe asking questions of Putin as to what's going on with this world. As you say, Gavin, yeah, focus is the mind. So maybe that could be a blessing in disguise, in that more pressure is put on Putin from those who, have a lot of money in the country to maybe start looking at ways of getting out of this mess. But conversely, there's also the risk that Russia scales up their attack and it all gets a bit more nastier. We'll keep our fingers crossed that doesn't happen. Also in geopolitics, China and India are still continuing a long-running spat, and both sides have kicked out each other's journalists from the country. So another geopolitical situation to keep an eye on there. Obviously, there's been problems on the borders between China and India, which have been going on for a long time as well, but a slight escalation there. That's all I've got for the headlines. I can't ask anyone else if they've got anything because there's no one else here. So unless you guys and girls have got something you want to throw up in the chat that you feel is important, please feel free. Otherwise, we shall get straight into the prices. So just to give a little bit of an update on some of the trades I was doing. I was in long euro dollar off of the 107 level, been nicking bits and pieces off in the rallies above, but now we've broken right down. I'm stopped out on the balance of the trade on that one through 70. This break potentially means we could be well on for a test of the 105 area, which is a real humdinger of a level, and I'll just show you that quickly because I didn't show it yesterday. So you can see there the 105 level has been a big level going back donkey's years, and it goes back even further than that. If I can show it on this chart, a bit messy, but let's see if I can put it on that one. There we go. That's a bit clearer for you, even though it doesn't go back as far. There we go. So you can see the 105 has had points that we've hit it, come close to it on a lot of occasions over the years. It really is one of these big old levels that you've got to keep an eye on. You know, it had an effect even when we came down the last time in February 2017, and then 2022 we messed around there, and then obviously coming into 2023 we've messed around there as well. So a big level if we head down there, and this break of 107, which is also a decent level, could be significant in taking us down to that 105 area. Now the resistance is pretty clear at the moment. You know, we broke through this 107.60. That's also been a prior decent level. That's been the main area of resistance. We're now finding resistance under 107, so that's going to keep the pressure on there. As you can see there, we've had the break and now we're holding the break, so that's our next level. Also need to keep an eye on this 70-75 area, which is where the former low came in yesterday, and we messed around there this morning before the break. We're now just struggling on a test of that now, so these resistance areas are potentially stepping down. If we hold here, then there's going to be further downside, and as mentioned, I think we may be on for a test of that 105 area. Why that's also important is because it is the 38.2 fib of the big rally since last September, so that is going to be putting this rally to the test if we get down to that 105 area. We do have some intermediate potential stopping points on the way down, 106, 35, 40, and then down around the big figure 106. But as you can see, it's not a level I'd trust too much. The price action's been a bit wishy-washy there of late, but moves down towards that 105 have been where all the action is. As you can see, we've had, since the break above it, we've had really only one real test. You can probably call this one here half a test down at 105.15. So you can see all the price action down there. It gets very sticky into that area. That's probably about the only place I'd look potentially for longs again, if we to head down there, and depending on the reason. Dollar yen's been a bit funky, let's call it that. You know, we had this move off of 141 yesterday. Oh, let's go. Where am I going? Let's get into the right one. There we go. So we had the move off of 141 yesterday. Didn't quite get down to the 139 area, but we broke briefly below 139.50, this old fib area, 50, 55, 60, call it. We're back above at the moment, but just running into trouble again at 141. I'm not sure about this one at the moment. It has come off the highs. It's stopped its grind higher, but then I don't know if this is a bit of a pause or if we're going to see it continuing to keep moving back up towards those highs again. I've seen a few comments coming out from banks talking about the BOJ stuff yesterday. You know, and what it meant. Does it mean that intervention's on the way, and so on and so forth? I don't think it does. I don't think they're anywhere close to talking about intervention or anything along those lines. But if the wider market is thinking that perhaps they're going to get on the jawboning bandwagon, it may make the upside a bit more of a struggle for that one. But then we have to match off what's going on in yields. And if we look at the 10-year yield, it's continuing to look pretty soft. So around these low 3.6 is going to be a bit of a test for this. Again, is this just a bit of blow off from what we had over the debt ceiling? Because this has really pretty much dropped since we got the debt ceiling deal. We could find that we do maybe find a bit of a bottom here, or at least a temporary pause, as I said, depending on confirmation of those votes. I think if we get confirmation of the votes, we probably see another leg lower in yields as the market withdraws its premium for owning US paper now that the default risk is out the way. So I wouldn't be surprised if we get a little bit of a pause into the votes and then a reaction afterwards. So still, we're going to be in wait and see mode, particularly for the dollar. You know, does that confirmation give us another run to the highs, or does it give us a little bounce and then the sellers come piling in again? So once again, it's a bit of a wait and see game in terms of what happens with this debt stuff. We just have to get over each mountain as we come to it. Dollar CAD making a fist of things at the 136.50, which again has been another level recently that has been very, very hard to break. So that's been going back since April when we had a little break above it, but it's been pretty solid again last week, pretty solid again right now. I would say though, we are getting a few knocks on the door of this one, so I wouldn't be surprised if we see it break on further dollar strength. Or oil is also looking a bit soggy, so keep an eye on that one there, because that's going to be a double wind for dollar CAD to the upside. If we do get above there, we've got some called them minor levels, 137, 137.60, but the big level is going to be 138, which is where we came off and found resistance straight after the move to the trend line. And that trend line is coming in, give or take a few pips, at 138 as well. So if we do get a break above here, this is the area I might be looking at for shorts, because the techs are just lining up nicely up there. And if this one wants to play nicely with the techs, as it can do, I'll just bring it out a bit. As you can see there, from these, I don't know if you want to call it a wedge or whatever, but it's a fairly long running one, and the price is playing nicely between it, as the Looney likes to do on occasion. So that's an area to keep an eye on, up in the high 137s to 138 if you're looking to get into shorts on that side. I'm not sure whether to go with a break of this 136.50 area. I don't know if it's going to have enough legs to give a run up there, but keep an eye on that one. Anyway, let's have a look at some of your questions going on here. If you've got any things you want to look at, throw them in the comments for us, please. What do I see in wheat and nat gas? Not a lot, to be honest with you. I don't think I've got wheat on my charts. Let's have a look. No, that's probably a question you want to ask Dale. There was a story I put up in the ForexAnalytix newsroom yesterday regarding China. Was it about wheat or was it about corn? I need to go back and have a look. Give me a second. I'll have a quick scroll through. Yes, it was wheat. So apparently there's been some heavy rain in China that's damaging the harvest over there. So they're potentially going to be short about that. So if you're looking at wheat, as I haven't got the chart up here, I wouldn't even know where to look. It might mean that the China is forced to seek imports from elsewhere, which may obviously be something that they forces them to maybe take a softer line with the US. Obviously a big producer over there as well. So if you're looking at wheat, that and I'll put that headline for you in the comments here, just so you can have a read of that. So have a read of that, because obviously if China's on the hunt for wheat, that's going to push the price up for that one. So nat gas, well, obviously we're entering summer season, so no surprise to see prices still remaining low. You've got to really look at this one from a longer term perspective. You know, if you're getting down to these sort of levels under $2, you know, you're going to get the swings, the seasonal swings with nat gas. It's all pretty quiet on the European front regarding gas. They've all been busy stocking up over the summer and the last few months. Winter wasn't quite as cold as many expected, so that helped on the European front. But I expect that to start rearing its head again in terms of what's going on with Russia and supplies in the latter point in the year. But for the moment, gas remains pretty subdued down at these levels. Let me know what you're looking at, Iron. Are you long, you're short, you're looking to buy, sell? Not that I'm a broker, but let us know what you want to do. RA, why are the brokers charging more than 1.68% a day interest swap charges for things such as dollar TOI long, which makes it uneconomic to short the lira? If you're talking a Turkish lira, you're lucky if you can trade it at all. I'd be more worried about the margins it's going to cost you to trade Turkish lira. There's not too many brokers who have probably got it switched on. And as for the charges, it all depends on what they can actually get on the other side. You know, there's not many people who are going to be looking to pay funding or, you know, give you balances in terms of Turkish lira for brokers. So it's probably a liquidity issue more than anything else. You know, I know a lot of people would like to get in on the carry, but also the carry isn't that big. You know, Turkey's rates have been coming down 8.5%, I think they are now, and the Fed is up at you know, in the fives. So the carry trade, while still there, has been narrowing, and that's also going to impact the cost for things like funding, so on and so forth. And don't forget, you pay probably 1% on top to the broker either side. So if the interest rate differential is 2%, you're only going to get 1.5% for your broker. On the other side, they're going to lob on 1% if you're paying the carry, because they've got to take their pound of flesh. But it's all depends on your broker, really, what they're getting from their liquidity providers. That's how it's all calculated. Euro NOK, who was looking at Euro NOK? Giuseppe. Oof, this one's been a bit of a monster, hasn't it? I got knocked out yesterday. That didn't last long. My attempt up at these highs here, shorted into that level there, had a pretty tight stop, 11.95.75. I didn't want to give it a lot of room, as mentioned yesterday. That proved to be pretty wise, because look at it now, it's really off and running. As for the tops and where it can go from here, well, your guess is as good as mine. The tech is pretty bleak up here. You know, you've got to take this for what it was. You know, this was the COVID move, so I wouldn't call it a real price. So we're really in uncharted territory up here, pretty much. I'm certainly not going to look at shorting it at all right now. It is potentially trying to make some tops in play around this 12.06 area. So if you are looking to short, what you want to see is the price action over, you know, a few sessions where it's struggling to then make new highs, a bit similar to what was happening here. So we got up to that prior high, which we had. Let's come out a bit. Let's just tick it up now. So we had these highs, we tested these highs, we held these highs, we tried a couple of times on these highs. That's what gave me the conviction to try a trade here, but to keep it tight. So if you want to be short in this again, you need to see, you know, a decent consolidation period where we're not going higher. And if that's the case, then perhaps we're heading lower. I haven't seen if the Norges have been out with their FX report yet. That's supposedly to come today. I don't know if I've missed that, but I'll have a little scout around for that. That might give us an indication what's going on. But if you're long, then you're happy. This is your next support point. You know, if we get a test of there, then you want that to hold, and then you can continue the rally higher. If we break back under there, then perhaps we are marking this as a bit of a fake out, and then we're seeing that something's potentially changed. But as I say, if you're looking to get into shorts, and I know a lot of people are still looking at shorts, you now want to see a period where you're finding decent resistance. That was a type of price action we were getting in Aussie dollar. This one I'm still short a little pinch from the 68s. Got a bit left to cut on those shorts there. I did take some more off at 64.84 this morning. So this is what I'm talking about with the price action. So Aussie dollar came down, we found a low, we found a higher low, we found another higher low, we found support. This is the price action you want to see. If you want to start catching knives or picking tops, you want to see a decent period. So, you know, this lasted about a week. It gives you some conviction to be long on these areas down here, so down into the 65s. But you need to know what you need to bust for a real move higher. And we couldn't get and hold above this 65, 45, 50 area. So it kept the price in the balance. And what's happened now, we've had the breakdown. Now, if you were longs off here, and I did try a long up at this area and it didn't work. But if you were trying longs off the 65s, you want to be taking profits, you know, taking some off the table on tests up to this area here, in case it's going to fail. And fail it did. That way you can lock in some profits, and you're not risking a lot. You know, you only need to stop under these lows, pretty close, and it's a low risk trade. And if the price action continues in your favor, then the longer it holds support, the greater the chance it's got to bounce. In this case, it's broken, so we're potentially heading lower. This move now could invalidate all that happened here, and it becomes another situation like back here where we found support, but couldn't break higher, and we go down lower again. The same for Euro NOK. You know, you want to see that in reverse. So you want to see highs and then a lower high and continued lower highs, and in a period it gives you the conviction to say, right, fine, I'm going to try shorts in Euro NOK because I've got levels that now I can define my risk against. I know if I break above 1206, 1207, I'm likely wrong. So I don't need to have a stop up at 13 or 1250 or 1220. It only needs to be really tight above these prior highs. So look for further development of these. This is why watching price action is so important. It tells you the clue, it gives you the clues to say, is it worth trying to trade here or not, or should I leave it alone and come back later? Right, just looking around some of the other pairs. Euro sterling remains on the soggy side. We're going to be looking like we're going to be testing down towards the 86 level. Let's get on a better chart. Let's have a look at the old 4 hours. Bingo. So we are finding a bit of resistance now into this zone, 44s, 50s, that sort of area. We are making smaller lower lows, so that keeps the bearish pressure on. So you know where your main resistance points are now for this one. 86.70s is the main one. Look to see if we build further resistance against this level here. If that's the case, then we're going to be testing the low 86s, and of that, 85.70 is potentially the bigger level underneath, and down towards that 50 area. So that'll be a real good area to look at if you've been short for taking profits, and maybe for longs. I don't know if I'm too keen on taking a long down here at those 86, 85, 70 area, mainly because I was long. I was stopped out of my final positions this week, And the Bank of England is looking more hawkish now, and the market's looking more hawkish for the Bank of England. What I would like is perhaps to see the market getting really expectant for the Bank of England and forcing euro sterling maybe down towards these sort of areas, the 85s, 84s areas. Because if they go to the extremes, that's when I'll look to try a counter trade on that. But in the meanwhile, I'm a bit neutral on euro sterling at the moment. Let's see what you're up to today, Ali. Every day you've got a trade on. Short gold at 1962, stop at 1971. Let's have a look at gold for you. Weren't you short gold at the beginning? Was it gold you were short beginning of this week? I can't remember now. So you're short at 62, stop at 71. Okay, so you're just playing in this area, really. Yeah, it's not. I've got a level here. It's a line at 61. It's not much of one though. It's just one of those. It's more a line I just keep an eye on rather than use it to trade. Obviously, it's looking a bit better down towards 1935, and then the resistance you're looking up towards that 1984, 85 area, which been a prior traffic point up there. Yeah, good luck to you. You want to be getting below this sort of area. You're looking at 1949, so you're pretty much scalping it, mate. So I hope you get it. 1949 profit take. Yeah, you might want to think about 150 as well. At least maybe taking some off if you don't get your 149. But that trade looks all right. I think if you're back above your entry, then you're looking a bit dodgy. But your stop's just above these points here. So yeah, have a good one on that one. Hope you make lots of pips. What's holding gold down? If dollar is strong, again, I don't. Right now, for me, a lot of this market is a bit confusing. I'm finding it tough to get myself in the rhythm of what's driving what. I expected gold to come down on the US debt situation getting resolved. I was looking up at 2075 up in this sort of area to maybe put some on. I missed. Well, I didn't get in there. My idea came afterwards. So when we were around here, I didn't put anything on there. But then it started falling anyway before we got to a resolution. And it hasn't done an awful lot since we've got a resolution. So maybe this was the market getting expectations up that there was going to be a deal happening. I don't know. So here, we can't go lower on the back of a deal for now. And if we get confirmation of a deal and we don't go lower, that's going to suggest maybe we've got a bottom in place. But in terms of the dollar, as I say, I'm a bit confused what's going on. Dollar yen's rising. You could point to the good US data or the better US data, sticky inflation. Bank of Japan still on easy street as a reason. But then you look at everything else. ECB still hiking, still hawkish, and yet the euro isn't rising. Euro dollar's falling. So I'm not overly convinced about what's happening. And when I get like that, I tend to just pull back to the charts, pick the wider levels, pick the stronger levels, and just trade the pure techs until I get a clean idea over what's going on in some of the pairs. But some of the pairs are pretty clear. Euro NOK, we know the reasons why the NOK keeps weakening. It's because of the central bank. Oil's now falling as well. There's several winds blowing behind this pair. So there are still pairs that are pretty clear. Dollar China still pretty clear. Data's not looking too good. Still over there. They still might be looking at easing. You've got a reason why the currency is weakening. So there are some currencies that are clear. Euro sterling's are clear because of the greater expectations of the Bank of England. But there are some others that aren't overly clear. And those are ones I'll just take a bit more caution on things. What's that, Ali? What time is best to put some gold bid on positions? I know Fed is not going to hike every time. Sky's not the limit. I'm not sure I get you. What do you mean the best time to put on some buy positions? You put on any position when you feel the trade is good. If you're trading off tech levels, whatever, you know, if you want to trade 5 minutes for a central bank, I wouldn't suggest it. So that's not a good time. 5 minutes before the NFP data is not a good time to start putting on trades. So I'm not really sure what you mean by time exactly, but you can let me know. Kiwi CAD. Oh, you've got a bit of both there, haven't you? Nut. Let's have a look at that. Kiwi CAD. Don't expect to see any funny colour lines on the chart for this one, mate, apart from moving averages. Yeah, so here you've got two forces. So obviously you'd think that CAD would be weaker on the oil front, but it's not. Kiwi's taking all the moves on this one. But this is pretty much the same as the RBR. I think what you're seeing here is just call them the cross currents, if you like. Is this risk off? Is this pure risk off that we're seeing in markets at the moment, with a lot of the Antipodeans falling, Aussie dollar falling, Kiwi falling? You're not seeing the CAD fall on this. So I haven't really got an opinion on this one. You know, I have got a line on there down at 80.48, so I must have looked at it at some point. It's been a prior low going back, as you can just about see there. It's on the text, but you know, Kiwi dollar is doing the same thing as Aussie dollar. You know, you've got to look at it mainly from the Kiwi side. You know, it was strange from CAD yesterday because dollar CAD was moving the opposite way, or CAD was moving the opposite way to oil yesterday morning, which was a bit of a stick out. It shows we were trading perhaps the dollar side of things and risk more than we were trading on the oil side of things. So for Kiwi CAD to be going down as much as it is, it shows you the influence is more on the Kiwi side and what's happening there. So that's likely being dragged from what's going on in Kiwi dollar. So it's a bit of a follower rather than a leader at the moment. Right, unless you guys and girls have got anything else in the pipe you want me to look at, let's have a quick look to see what's coming up today. Any big data? We've got jolts coming up later. Keep an eye on that one for a bit of a jobs fix. Canada GDP is also out, as well as those German May numbers, and as expected likely to come in much lower. And actually, I'll just call up the calendar. It looks like expectations have been revised for those German numbers, when and if it comes up. Just on Reuters, I'm seeing the HICP for Germany now expected at 6.8%. Why is that not working? Come on, you bugger. 6.8% versus 7.6% prior. So they have been drawn down, those expectations, following all those regional CPI numbers. So anyway, that's what we've got coming up today. Good luck with your trading as always. Thank you very much for coming to the Flow Show and supporting us here. Do have a great day, and we shall see you all hopefully with some colleagues tomorrow. Have a good one.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.